Markets are down, the news is all fear and confusion, and even the experts can't agree on what comes next. If you're watching this, maybe you're feeling stuck, not quite ready to buy, but also wondering if you'll miss your chance if you wait too long. The truth is, this kind of messiness, it's normal. It's always messy before things get better. But knowing that doesn't always make it easier to act. That's what this video is for. Not to tell you when the market is going to recover, because let's be honest, no one can do that. But to share the signs that historically show up when things are starting to turn. And more importantly, how to prepare for that turn, without fear and without needing to get it exactly right. Now, here's something that might surprise you. In almost every major downturn, from 2008 to COVID, to what we're seeing now, the moment things feel the worst is often when opportunity starts quietly showing up. It's never a clear green light. It's more like a faint signal, one that's easy to miss if you're only focused on the headlines. That signal might look like solid companies suddenly trading 30 or 40% below their previous highs, not because their fundamentals collapsed, but because the entire market is panicking. Or it might show up as a market that starts climbing for a few days straight without any major news driving it, like it's catching its breath before anyone notices. These are the moments seasoned investors call autonomous recovery. The market begins to heal before the headlines turn positive. And while it's subtle, it's not just a hunch. It's pattern recognition, backed by historical data and years of behavioral market dynamics. That early movement, especially in the face of negativity, is one of the most telling signs that fear may be peaking and opportunity quietly returning. Take valuation, for instance. When price-to-earnings ratios fall back to historical norm or even below them, that doesn't guarantee a bottom, but it does tell us that a lot of the risk may already be priced in. For example, in one market analysis, NVIDIA's PE ratio reportedly dropped from above 40 times to below 20 times during a broader correction, despite its business fundamentals remaining strong. AMD showed similar patterns. This kind of valuation compression, falling multiples despite strong earnings outlooks, has historically aligned with long-term recovery opportunities. And then there's sentiment. When retail investor pessimism spikes, as it did when consumer confidence readings fell sharply to around 50.8, or when major institutions noted record outflows from equity funds, it's often a sign of capitulation. You can also see it in tools like the VIX, the so-called fear index. When the VIX rises above 45, as it did during past panics, it's often followed by periods of strong recovery. Similarly, sentiment surveys, like the American Association of Individual Investors Sentiment Survey, have shown that some of the best one-year returns occur when bearish sentiment is at its peak. Historically, some of the best 12-month market returns followed these extreme sentiment troughs, as seen during previous cycles like post-2008 and post-COVID. But even with all of this in mind, knowing the patterns, seeing the signals, the hardest part is still taking that first step. Behavioral finance studies have shown that hesitation often leads to underperformance, not because people chose the wrong investments, but because they waited too long. The Dalbar study, for example, has consistently found that the average investor underperforms the market simply due to poor timing. Morningstar's research echoes this, showing that investors tend to miss the best days because they try to time their entries too precisely. So, how do you step back in when the future still looks uncertain? Here's one mindset that's helped many long-term investors stay steady. Don't think of it as buying the bottom. Think of it as sending out a scout. Just like you wouldn't send your whole army into unknown territory, you don't have to deploy all your capital at once. You send a little ahead, a small position, and see how the market responds. If it holds, if it recovers, if the bounce seems to stick. And if it doesn't, you've still got reserves. You haven't overcommitted. That kind of approach turns fear into strategy. It creates room to think clearly. Some even keep a set percentage of their portfolio say 10 to 20%, in cash or money market funds during uncertain periods, not just for peace of mind, but for optionality. That flexibility becomes a quiet advantage when everyone else is frozen. Now, of course, it's not just about buying. It's also about not doing certain things, like chasing the loudest voices in the media, or holding on to fragile stocks that may not recover just because they've dropped the most. For example, some high-growth names that were trading at PE ratios of 150 times may drop to 80 times. But 80 can still be far from reasonable if the fundamentals don't back it up. And it's easy to hold on to past winners out of nostalgia. Many investors, even professionals, keep stocks in their portfolios simply because they once performed well, even when their outlook has changed completely. Even some institutions fall into that trap. Take the ARK Innovation ETF. It gained massive popularity during the tech surge and attracted billions at its peak. But many of its holdings had shaky fundamentals, and when the air came out of the market, the fund fell more than 70%. Or consider pandemic-era favorites like Zoom and Peloton. They soared during lockdowns, and many investors assumed that success would continue indefinitely. But as conditions normalized, growth slowed, and their valuations, even after steep declines, still didn't justify holding on. These examples are reminders. Price drops alone don't make something worth buying back into. Fundamentals still matter. What's worked more reliably over time is rebalancing towards strength. That doesn't mean guessing the next hot sector. It means rotating into companies that got pulled down with the rest of the market, but still have solid fundamentals, healthy balance sheets, and growth drivers intact. And above all, it means remembering this. The market doesn't reward perfection. It rewards preparation. Let me say that again. It rewards preparation. And being ready, not reactive, is one of the most powerful investing positions you can be in. So if you're sitting on the sidelines, unsure what to do, maybe now isn't the time to jump all in. But it is the time to learn, to watch, and to get ready. Because when the fog clears, and it always does, you'll want to be moving forward, not playing catch-up. And if you're still wondering whether 2025 is a good time to start investing at all, even with everything going on, you may want to check out another video I made. It walks through a simple strategy that makes getting started feel a whole lot easier. You can check that out right here. And remember, you don't need to time the market perfectly. You just need to stay in the game, with your eyes open, your plan ready, and your peace of mind intact.